I really like the concept of debt because it helps you understand, if you understand monetary policy, the way that the economy is functioning, how the central bank and in extension other people look at the growth versus inflation dynamics. But this is not meant to be a macro conversation. This is meant to get people to understand how debt works and where it fits in their portfolio. So, but let's start by giving an overview of why interest rates rise and why interest rates fall, and we'll go from there.
Absolutely. Look, to me, the bond markets, the debt markets, or the interest rates are like the Gangotri and Yamunotri of everything. It is the starting point of everything and anything globally, whether be equities, whether be commodities, whether be any macro cycles, any minutest part of the economy you want to analyze and you want to get deep into it, you have to start right at the top, which is the interest rates in the economy, right? When you have interest rates falling, which is called a benign environment, which is where we have been for last 1 or 2 years globally as well as in India, right? The repo rates in India have fallen down to 5.25, which is almost a historic low, barring the COVID time when we went as low as 4.5. Right, which means we are following a very loose monetary policy. That means RBI is comfortable by keeping the rates low, which means your EMIs, my EMIs, the corporate balance sheets are looking healthy, our EMIs are lesser, we are paying lesser for the loans, raising funds is easier. There is overall a benign environment, right? Liquidity is also decent, surplus, so that's good. That's prompting growth, right? So when your interest rates are low, growth gets a booster. Inflation also goes up because the money supply is abundant, right? So when you have larger pot of money chasing the same amount of produce, then the prices go up in the economy. So inflation shoots up. When
I mean, just as an example of that, for example, if you're talking about cars, I was saying that suddenly the interest rate on a motor loan drops, and anyway you were thinking of purchasing, but then now is an incredible opportunity, discounts are also available, you will go and make that purchase. And just like you, there are several other people who also would tend to do that. And so the car company has to invest more, set up additional capacity. They have to hire more people, jobs go up, people start spending more money. That entire flywheel gets greased and starts moving faster.
Completely. I think very brilliantly put, Alex. And I think that's the growth engine gets a big amount of fillip overall in the economy. And so lower interest rates kind of boosts your growth, which is good for the economy. But inflation can be a menace. If the inflation goes beyond RBI's tolerance limits, then you have the rate cycle going up again. When that's called the tightening cycle. Once the rate cycle tightens.
And how does that happen? If you're talking about the car example, then you're talking about suddenly there's this big demand for cars. What goes into cars? Flat rolled steel, various other components, tires, rubber, etc. All of those prices start going up, and that feeds into your inflation. And the RBI, by the way, at this moment is an inflation targeting central bank.
Absolutely.
And so when it sees inflation tick up, it has to get ahead of the curve and say stop now.
Yes.
And so it has to make things more expensive. It has to dissuade you from consuming. Totally. And so, as a result of which?
Yes. So when the economy heats up, RBI will kind of try and put some brakes onto the economy, which is by tightening the interest rates, as a result of which you will feel some checks and balances on your personal balance sheet also and on the corporate balance sheets also. An economy kind of slows down. So RBI is always in a fine balancing act, not to let it cool off a lot, not to let it become too hot, right? So that's where RBI comes in. Growth versus inflation is the key focus area for all central banks across the world. And then you add few other dimensions. You check your currency, you check other global factors, how are the US markets reacting and other things. But yes, inflation versus growth is the biggest driver of debt markets.
Okay.